Brad Williams, Frugal Finance, hedging and FRA position. Example, hedging and FRA position. An FRA market maker sells a US 100 million 36 FRA. That is an agreement to make a notional deposit without exchange of principal for 3 months in 3 months' time at a rate of 7.52. He's exposed to the risk that interest rates will have risen by the FRA settlement date in 3 months' time. Dates, December 14th. We have a 3.6 FRA rate at 7.25. March future price 92.50. Current spot price 6.85. So he's worried about that 3 month period. The dealer first needs to calculate the precise hedge ratio. This is a 3-stage process. Calculate the nominal value of a basis point move in SOFR on the FRA settlement payment. Nominal BPV equals FRA times 0.01 times N360. Therefore, 100 million times 0.01 times 9360 equals 2,500. That's the nominal value, point move. Find the present value of 1 by discounting it back to the transaction date using the FRA and spot rates. Present value of a basis point move is equal nominal value, a basis point, divide this 1 plus spot rate times days in hedge period, divided by 360, times 1 plus forward rate times days in hedge divided by period 360. I have it here, but I also have it here. So we have this 2,500, that's the notional. 1 plus, here's that 685, times, well, we know it's 3, divided by 360, times 1 plus, here's the 752, times the trade period, which is 24215. Determining the correct hedge ratio by dividing 2 by the future tick value. Hedge ratio equals 2412, divide this by 25 equals 9648. I think this should say calculate the hedge ratio by dividing 25 by the futures tick value. And we have 96, exposure period, hedge period, transaction, FRA settlement. FRA dates, the appropriate number of contracts for the hedge of a euro 100 million 36 FRA would therefore be 96 or 97 contracts, as a fraction is under 1/2. 96 is correct. To hedge the risk of an increase in interest rates, the trader sells 96 ECU 3-month future contracts at 92.50. Any increase in rates, that means lower prices, any increase in rates during the hedge period should be offset by a gain realized on the futures contract through daily variation margin receipts. Dates, March 15th, 3-month SOFR 7.625, March EDSP 92.38. The hedge is lifted upon expiry of the March future contract. 3-month SOFR on the FRA settlement date has risen to 7.625. So the trader incurs a loss of euro 25,759 on his forward position. There it is right here, 26250. Divide this by 1 plus the new rate over the time period. We have euro 2625 discounted back over the 3-month period. We have this number I'm showing you here. We have 7.52 minus 7625. Think about it. We have that spread differential, and we have to figure out what that new nominal is. So it's 26,250. Then we have SOFR minus rate times date. We're going to discount this back, 26250. Divide this 1 plus 7265 times 90. That's just going to give us a rate, which is 25759. Therefore, 2625 divided by 1 plus 765 equals 2569, etc., 265. Futures, 12 ticks, 92.50 minus 92.38. This is what the futures are worth now. What happens? The euro 25279 loss on the FRA position is more than offset by the euro 28.8 profit on the futures position when the hedge is lifted. If the dealer had sold 100 contracts, his futures profit would have been, well, ifs and buts candy and nuts, we'd all have a Merry Christmas. If the dealer had sold 100 contracts, this would have been 30 grand, and you would have been accordingly a less accurate hedge. The excess profit in the hedge position can mostly be attributed to the arbitrage profit realized by the market maker. The market maker has sold the FRA for $7.52 and in effect bought it back in the futures market by selling it at $92.50 or 7.5 or a 2-tick profit. That's it. The logic, the math is rather simple. It's just knowing what the logic is. As I continue to state, the tools are available. The tools. This is the tool right here. There's no reason for you to try to brute force this when somebody already else has. So use the tools that are available and think through how this is working. Why is this discounted? Why is this number 28.8? Why is this 26,250? Why are we using certain numbers? Go through, work out the logic. Brad Williams, Frugal Finance. Thanks.